On May 22, 2026, a standard PDF document appeared on the official website of the China Securities Regulatory Commission. It carried the digital signatures of 8 distinct government ministries and regulatory bodies acting in absolute synchronization. This single text gives millions of mainland Chinese investors exactly 24 months to liquidate every single American stock they own and close their foreign brokerage accounts permanently. This administrative order directly governs a volume of wealth that defies conventional macroeconomic metrics. Chinese households hold approximately $51 trillion in private savings. This represents the largest concentrated reservoir of liquid deposits on Earth, a financial mass built over 40 years of industrial export dominance. While policymakers in Washington were actively congratulating themselves on the preservation of a fragile trade truce, Beijing quietly bypassed the diplomatic arena. They did not levy a new tariff. They did not alter an export quota. They simply approached the financial plumbing that allows a retail saver in Shenzhen to place money into Apple, Nvidia, or a United States Treasury bond, and they turned off the valve. To understand how this valve became a critical geopolitical fault line, one must analyze the infrastructure that allowed the capital to migrate in the first place. For over a decade, a specific digital corridor operated with tacit state permission. Modern fintech platforms, most notably Futu, Tiger Brokers, and Long Bridge Securities, provided ordinary Chinese citizens with a seamless digital interface to Wall Street. A retail investor in Shanghai could download an application, complete a digital registration, convert domestic renminbi into US dollars, and buy foreign equities. This mechanism functioned as a silent, continuous conduit, routing billions in domestic Chinese wealth away from the domestic economy and injecting it directly into the Western financial matrix. This outward flow accelerated due to a profound internal crisis. The Chinese real estate sector, which historically absorbed over 70% of all household savings, entered a terminal structural correction. Local equity markets remained stagnant and volatile. The American stock market presented itself as the only viable mechanism for consistent wealth preservation and capital appreciation. This dynamic generated a major systemic contradiction. The private savings of a population locked in a generational, civilizational rivalry with the United States were actively bidding up the S&P 500 and providing structural liquidity to the American corporate sector. Every transaction helped fund the economic ecosystem of the very superpower attempting to restrict China's technological advancement. The strategic recalculation intensified following the financial weaponization of 2022. The abrupt freezing of $300 billion in Russian sovereign reserves by Western central banks exposed the underlying reality of the modern financial system. It demonstrated that assets held within a foreign-controlled infrastructure are not absolute property. They are conditional privileges that can be revoked by a keystroke in Washington. Beijing recognized that dependence on Western financial rails constituted an existential strategic vulnerability. The first defensive reaction occurred in late 2022. Regulators delivered an informal verbal directive to Futu and Tiger Brokers, instructing them to halt the registration of new mainland clients. It was a polite bureaucratic warning, an advisory measure that left existing accounts untouched. That era of regulatory ambiguity ended definitively on May 22, 2026. The transition from informal guidance to an absolute, multi-agency implementation plan marks the shift from defensive capital management to active financial decoupling. The new mandate does not merely request a slowdown. It commands a total wind-down. The text of the order targets the operational existence of the cross-border brokerages. It prohibits the acceptance of any new buy orders from mainland clients during the 2-year transition window. More critically, It authorizes the total confiscation of all historical gains generated by these platforms within the mainland market, branding their core business model as an illegal financial activity. The global market recognized the finality of this shift instantly. In a single trading session, the US-listed shares of Futu cratered by 28%. Up Fintech, the parent corporation of Tiger Brokers, watched 25% of its total market capitalization vanish in a matter of hours. A quarter of their corporate equity evaporated because the state determined that their role as a bridge to Wall Street was no longer tolerable. This is not a routine measure to stabilize a fluctuating exchange rate or manage temporary capital flight. It is a permanent infrastructure closure. Beijing has evaluated the macroeconomic landscape and determined that the financial integration which defined the era of globalization is now an unacceptable exposure. The 24-month countdown is now ticking. The servers, the applications, and the clearing networks that linked millions of mainland savers to New York are being systematically uncoupled. The initial tremor has already broken the cross-border brokerages, but the deeper structural fault lines are just beginning to fracture, setting the stage for a total re-engineering of how money moves across the planet. The transition from a theoretical timeline to physical market mechanics began exactly 48 hours after the May 22 announcement. The 2-year window did not encourage an orderly exit. It initiated an immediate mathematical acceleration. Millions of retail investors realized simultaneously that the first movers would capture the highest asset valuations, while the late majority would liquidate into a collapsing market. The technical infrastructure broke first. Automated selling programs operated by Futu and Tiger Brokers experienced unprecedented traffic spikes, logging over 14 million simultaneous account logins in a single morning session. The clearing pipelines between Hong Kong and New York bottlenecked. Settlement delays stretched from the standard 48 hours to 5 business days as the clearinghouses struggled to process the sheer volume of liquidation orders. This mass exit generated an immediate economic paradox. Selling American equities produces US dollars. Within 3 weeks, Chinese investors held a combined $98 billion in liquid cash, stranded inside foreign brokerage accounts. To return this wealth to the mainland, savers had to push it through the state-controlled foreign exchange mechanism, forcing a massive, involuntary conversion of dollars into renminbi. The sudden, artificial demand for domestic currency warped the exchange rates. The renminbi surged, breaking through the 670 benchmark and touching 6.58 per dollar. For an economy built on industrial exports, this rapid appreciation acted as an unguided missile. The profit margins of manufacturing hubs in Zhejiang and Guangdong, already running on razor-thin differentials of 3 to 5%, instantly evaporated. Export orders fell by 6.8% in June alone, as foreign buyers found Chinese goods suddenly overpriced. Beijing attempted to neutralize this currency pressure by forcing the returning capital into the domestic bond market. The People's Bank of China issued an emergency quota of special sovereign bonds, expecting the capital to absorb the debt quietly. Trillions of renminbi flooded the domestic fixed-income market. This massive liquidity injection created a structural trap. The yield on 10-year Chinese government bonds collapsed to an all-time low of 1.65%. This yield compression broke the balance sheets of the domestic banking sector. Commercial lenders, already carrying an estimated $3.4 trillion in non-performing loans from the ongoing real estate liquidation, found themselves holding massive quantities of state debt that paid less than the rate of inflation. The net interest margins of over 40 regional banks dropped below the critical 1.5% survival threshold, rendering them structurally unprofitable. The economic pressure quickly converted into social friction. The affluent urban middle class saw their global purchasing power systematically dismantled. They could no longer hold international equities. Their domestic property values remained underwater, and their domestic bank deposits yielded virtually nothing. The implicit social contract that sustained 40 years of political stability, the preservation of private wealth expansion in exchange for total state authority, fractured under the weight of the restrictions, sophisticated capital reacted by abandoning the transparent banking system altogether. Savers bypassed the official currency controls by migrating to illegal, highly organized shadow infrastructure. In the border city of Shenzhen, underground banking syndicates saw their daily transaction volumes surge by 340%. Capital flight did not stop. It simply went dark, moving through unmonitored over-the-counter channels and digital assets networks. Simultaneously, a physical run on tangible wealth hit the domestic markets. Citizens swarmed commercial jewelry and bullion outlets, attempting to convert their digital bank balances into physical gold. The Shanghai Gold Exchange recorded a premium spike of $95 per ounce over the London International benchmark. This was not an investment strategy. It was an expression of systemic panic, an effort to hold physical mass before the state locked down internal electronic transfers. The state security apparatus intervened immediately, transforming a financial crisis into a law enforcement dragnet. The Ministry of Public Security deployed automated algorithms to track provincial wire transfers. Any domestic account moving more than 50,000 renminbi across regional borders triggered an automatic administrative freeze. By mid-June, the digital payment accounts of over 3 million citizens were locked without warning under suspicion of illicit capital flight. This defensive measure triggered the ultimate systemic feedback loop. The aggressive freezing of accounts designed to stop capital flight created a domestic liquidity panic. Ordinary depositors, seeing their neighbors' digital wallets locked by the state, rushed to physical bank branches to withdraw cash while they still could. In regional provinces like Henan and Anhui, lines stretched for city blocks outside local credit cooperatives. The banking system faced a classic solvency crisis, manufactured entirely by the state's attempts to maintain control. The shockwaves traveled back across the Pacific to Wall Street. The persistent, non-fundamental selling from Chinese accounts created a structural liquidity drain in the American technology sector. For 30 consecutive sessions, mega-cap stocks experienced unremitting downward pressure, stripping $750 billion in total equity value from the Nasdaq index. The 2-year window, conceived as a safety buffer, had transformed into a self-reinforcing countdown to destabilization. The financial plumbing had broken at both ends. Every regulatory patch applied by Beijing to stabilize the currency or contain the panic merely ruptured an adjacent pipe. The feedback loops were now moving faster than the bureaucratic decision-making process, carrying the world's largest pool of private savings past the structural threshold where orderly intervention remains mathematically possible. The structural realignment initiated on May 22, 2026, has settled into a permanent, icy equilibrium. The global financial architecture has formally bifurcated into two mutually exclusive, non-communicating networks. The $51 trillion in mainland household savings is no longer a fluid global asset capable of seeking maximum returns across international borders. It has become a heavily pressurized domestic mass, trapped behind a state-engineered digital barrier that grows denser with every passing week. The geopolitical consequences of this containment are rewriting the rules of international trade with absolute indifference to Western diplomatic objections. Non-aligned states and major energy exporters have ceased viewing the Western banking system as a neutral global utility. The operational launch of the Hong Kong Precious Metals Central Clearing Company in July 2026 completed the alternative trade loop that Beijing spent a decade drafting. Saudi Arabia, Iran and the United Arab Emirates now regularly route bilateral energy sales through the cross-border interbank payment system, converting oil directly into yuan and then immediately into physical gold bars deposited in expanded Hong Kong vaults. This loop completely circumvents the United States dollar and the SWIFT messaging network, stripping Washington of its primary geopolitical leverage, the power of secondary sanctions. When the automated clearing mechanisms operate entirely outside Western jurisdiction, a Treasury freeze order becomes a useless document. The petrodollar arrangement, which underpinned global demand for American debt for over half a century, has transformed into a fractured system where alternative settlement is no longer a theoretical option, but a daily operational reality processing billions in daily transactions. The domestic price for this financial independence is being paid directly by the Chinese urban middle class. The forced liquidation of global equity portfolios stripped millions of families of their only performing asset class. With the domestic property market frozen in a structural contraction and the Shanghai Stock Index locked in a state-managed, stagnant range, private wealth accumulation has ground to a violent halt. The state has preserved its capital sovereignty by systematically destroying the financial autonomy of its most affluent citizens, turning savers into economic captives within their own borders simultaneously. The institutional framework inside the mainland faces a mounting solvency crisis that threatens the core of the state's economic stability. The People's Bank of China has attempted to mitigate the regional banking collapse by introducing targeted liquidity injections and specialized asset purchase programs. These interventions are fundamentally delayed and structurally insufficient. The central bank cannot fix an underlying solvency problem with a temporary liquidity tool. By forcing commercial lenders to absorb massive quantities of low-yielding sovereign debt, the state has compromised the balance sheets of over 40 regional banking institutions, pushing their net interest margins below the point of survival. The systemic contagion has also crossed the Pacific, permanently altering the dynamics of Wall Street and exposing structural vulnerabilities in the American corporate sector. The sudden, unremitting removal of Chinese retail capital eliminated the steady, passive indexing bid that sustained the multi-trillion-dollar valuations of American technology monopolies. Volatility indexes have stabilized at structurally higher baselines, and major institutional funds have pulled back from aggressive expansion strategies. The cost of corporate borrowing in the United States has ticked upward as international capital demands a higher risk premium to compensate for a fragmented, less liquid global market, in an attempt to manage the growing domestic discontent and absorb the stranded wealth. Beijing recently unveiled the Sovereign Capital Reinvestment Strategy. This initiative forces displaced savers to invest their liquidated wealth into state-directed technological development funds and infrastructure bonds. The policy has failed to regenerate economic velocity. Trust is a psychological asset that requires predictable openness. It cannot be manufactured by administrative decree or coerced by capital controls. Savers are choosing to hoard physical assets and tangible commodities rather than risk their remaining wealth in state-directed enterprises that offer no verifiable yield. This structural fragmentation is entirely irreversible. The technical pipelines, the clearing agreements, and the regulatory frameworks that linked East and West have been physically dismantled and welded shut from the inside. There is no political mechanism in either Washington or Beijing capable of restoring the trust required for deep financial integration. The era of a single, unified global capital market maximizing efficiency across borders has reached its definitive conclusion, replaced by an era of defensive economic mobilization. The world now enters an unmapped historical terrain. The United States dollar retains its position as the dominant medium of global trade, but it has lost its status as an indispensable monopoly. The construction of the parallel financial off-ramp is complete, and the traffic moving along it is expanding exponentially. As the global economy divides into competing currency blocks, the systemic stability of the entire international order shifts from an architecture based on mutual economic dependence to a volatile permanent standoff managed by raw state power, where a single miscalculation can trigger the next catastrophic collapse.